Hi and welcome. I've got Michelle.Oddo with Leader One Financial with us today. Now, Michelle is a certified divorce lending professional. And I know in most of the transactions that I experience with my clients, there's usually either the refinance of a house, a purchase of a house, something to do with the mortgage. And so Michelle plays a key role in the divorce process. And I wanted her to be on here today to give us just some tips or things that we should be looking out for, especially for the do-it-yourself divorce people out there. They really need to know there's a few pitfalls that sometimes you cannot really fix those mistakes once made. And so anyway, Michelle, tell us a little bit about yourself and then maybe some tips that they should be looking out for.
Okay, well, thank you, Leslie. Thanks for having me here with you today. Sort of here with you, right? We're doing all this Zoom thing anymore. Michelle.Oddo, Leader One Financial. I've been in lending since '85, and I was an underwriter for many years. So I do have a little bit of a different approach when I look at these deals. I look at a lot of the backside, how the underwriter will look at it, and making sure we're doing everything we can to set everybody up for success up front so that that underwriter just approves the loan. You know, we don't have issues down the road. I am a CDLP, as you mentioned, certified divorce lending professional. So I would say about 20% of my practice is divorce lending. I do, of course, all different types of lending, but that is a big portion of it. And like you said, it's really important to be with somebody that understands that side of lending, because I mean there are lots of course just brings a whole other group of nuances and things to the mix that are really important to know the guidelines and understand how that works. So I think you had questions on, you had said like talk a little bit about what what things do people need to know, and what are some of the pitfalls. I can just kind of go into that. Do you have specific, do you have any specifics, or do you want me to just kind of say in general what I see?
Maybe in general what you see. I mean, the one thing I think a lot of people really think, oh, if I'm going to be divorced, I can't purchase a new home until after the divorce is final. And there's a lot of misinformation about that. So that might be something that they can probably do it, but tell us about the process and how it works in your world.
Sure. No, you're right. That is a big misnomer. I have people call me all the time and say, I spoke with this lender or my attorney or whoever they're talking to, it could be their friends. People get advice from all over when they're either thinking about a divorce or even going through a divorce in the middle. And a lot of that information isn't always correct. So in Colorado specifically, we are not a community property state. So actually someone can purchase a home if the divorce is not final yet, as long as some other pieces are in place and there's some protection, meaning the spouse that they're divorcing, from won't have access to that property. So we do that quite often. Some of the things that would play into that, into making sure that that could work, are if whoever I'm doing the mortgage for, whoever's purchasing that property, if they qualify on their own income and don't need necessarily support from the divorce to qualify to buy a home. So if I had a spouse who did need support from that ex, soon to be ex, meaning like maintenance or child support or both, and if they needed that income to qualify, then the pieces to the puzzle that would maybe delay the purchase aren't necessarily because the divorce isn't final, but it's because they haven't received enough support for enough months. So if they're going to do a conventional loan, we have to be able to show that it's agreed upon through either like the MOU, the Memorandum of Understanding, or the divorce decree, or the separation agreement, whatever it is they're filing, and that they've received 6 months of that payment. So if it's a conventional loan, we need a full 6 months received. We can actually close in the 6th month. So sometimes we'll write a contract maybe like 4 months in, and then closing on that 6th month of support, they get it on the 1st and then we close. If they do an FHA loan, they have to receive 3 months of support. So that could be a reason we would need to delay, but it wouldn't be just simply because the decree, the divorce isn't final per se. If the divorce is not final, but it's been written in whatever agreement they have, that the other person, the spouse I'm working with, will be purchasing a home and it will be theirs solely, as long as it's in writing, that they're protected in that way, and that the other spouse won't have access to that property. But that's some of the mistakes that I see in terms of when the couple are going through their divorce proceedings, whether it's, you know, with you, Leslie, a mediator or an attorney, just making sure that if support is needed to qualify, just bringing the lender in upfront. And you and I know how important that is, because the lender will know how much money is needed to qualify. And if they're agreeing upon a certain amount, but it's not enough, maybe something needs to be reworked. Like maybe the spouse needs to agree to take less asset, like less of a retirement or less equity in the home or whatever it may be, in lieu of getting a higher monthly support if they need that to qualify for the home that they're hoping to purchase. So again, just getting those things up front, qualifying up front, knowing how much they need to qualify with is really important. The other thing is how long will they receive the support for, and when will it begin? So, you know, child support is pretty cut and dry for the most part. I mean, usually it's what, till 18 or 21 if they're in college or whatever everybody agrees upon. But in terms of how long will it last, if they're going to receive maintenance, or what used to be called alimony, now it's called maintenance, I believe. But, you know, in terms of like how long they will receive it, not only does the guideline require that they have received it for 6 months, conventional, or 3 months for FHA at the time of closing, but also very important that it will continue for at least 3 years from the time of the first mortgage payment due. So again, you know, sometimes I get involved into a person's, you know, situation they're trying to buy, and the decree's already been completed before I'm ever involved. And even if they said 3 years in that decree, but they're already, you know, 6 months down the road, what do they have, 2.5 years left, or 2 years and 10 months or whatever, or, you know, just it's not enough time to qualify for the loan. So sometimes if the spouse that they've just divorced from or separated from, if it's congenial and everybody's talking and very, you know, it's a workable situation, they could go back and do an amendment and maybe get less monthly, but extend it longer. You know, there's things we can do. It's not like, okay, forget it, you know, we're just out of luck. But most times it's, you don't want to have to go back, right, and redo documents. It's better to do it right up front. So that's one of the things for sure that we see can be a problem if those things weren't talked about and set up properly up front.
Exactly. It's so important to get you in there early, because there are a few do's and don'ts. I was going to ask you too, just thinking about income. So let's say someone did come up short, they didn't have that 3 years, or something happened and they weren't able to use that income. If they were to rent the room or rent a room in their home, I mean, how does a mortgage lender look at that as income? What other ways could they show income?
Yes, you really can't use border income for qualifying. There is one program, it's called Home Ready. You know, it's basically like a first-time home buyers program, but there's a lot of parameters around that. Like they have to show that they were living with that roommate for the last 12 months and that roommate had been paying rent, and now they're going to move in with them into this new property. So that's usually not going to work in a divorce situation. So border income does not work. If they were buying a 2-unit property and they were going to rent out the other unit, then that would be acceptable, but not border within the property itself, like in a single family. So that wouldn't be, what I have done is kind of what we just touched on a minute ago. I've had a few situations where the ex was very, you know, it was super amicable. They just wanted to help their spouse get into a home. And they said, hey, yes, we need maintenance to qualify. Maybe we don't need as much as the total amount monthly that has been agreed upon. So as an example, let's just say the maintenance agreed upon amount was $3,000 a month, and there were only 2 years left on that agreement at the time I come into the picture, right? And we're trying to get qualified. Sometimes even though they've agreed to $3,000, I don't need that full $3,000 to qualify. Let's say I need, you know, $2,000 or whatever it is. So sometimes you can say, well, there's 2 years remaining on the term, and at $3,000 a month, that would be, what is that? 3 times 12, 36, $72,000 over the next 2 years. Let's take that $72,000, let's stretch it over 3 years or 3.5 years, reduce the monthly amount. And if that's enough to qualify, then we could do like an amendment to that MOU or separation agreement or whatever. And we've done that, and that does work. They can simply do that amend, take it to the courthouse, record it, and move along. So we've done that before. Many times for clients. I don't know about many, but multiple, at least a handful over the years. So things like that, you know, it's really hard, like you said. I mean, sometimes it can just pay off a debt to make it now work. There's other things that sometimes we can do to make the deal work. But obviously, again, if we can catch it up front, it's so much better in terms of that. The other thing is, you know, just separating debt. So I've seen like decrees or separation, you know, agreements or MOUs where and none done by you. You always do a great job, but other people that they're not specific. You know, they just say they'll each take their debt, or you know, they're just not very specific. So it's very hard for us because when we go back to try to qualify for the loan, and let's just say they have joint debt together, you know, it's hard to know who's taking what, and if they haven't separated those things in the decree, then there's no clear, you know, path for us to qualify on. So that makes it hard. The other thing is sometimes there's multiple children involved. Let's just say they have 3 kids and they're going to get support till 18, and there's a lump sum mentioned in that decree. And now, you know, let's just say we're way down the road and a couple of those kids have gone off that per, you know, like age wise, they're already off of the child support now, and there's only 1 left. So either the spouse that's going to be paying support or the spouse receiving support, to qualify for a home on either side of that coin, right? How do I know how much they're going to be paying or how much will be received? Because it wasn't split out per kid, and it's very hard for an underwriter. They can't just assume, you know, it was 1/3, 1/3, 1/3. So it just, the more that can be split out and made clear, the better for qualifying for a mortgage. And that's where, again, having that lender involved during the process is always better. Sometimes it doesn't work out that way, but it is definitely a much easier way to make it work. And another thing I see is, let's just say we are doing a refinance to pay off the exiting spouse out of the home. And we do that a lot. So for instance, 2 people own the home, 1 person wants to move on and buy a new home, the other person wants to remain and refinance that home, pay off the existing mortgage to get it into their name alone, and then pay the exiting spouse their half of the equity, right, in that home. What I don't always see in the decree, but it would be nice if it's lined out, is will they split the closing costs of the mortgage? Will the spouse remaining get to keep the refund on the escrow account, because they have to set up a new escrow account for their new loan? So when it's not lined out, then it can get a little hairy, and then there's some hurt feelings there. And in fact, I just had one like this, and kind of had to, you know, do a really nice long email so she could give it to the spouse who didn't want to help with the closing costs, you know, and just said, hey, listen, if you guys were going to sell the home, you would be paying a realtor fee, which would be much higher than, you know, the $3,000 in closing costs or whatever it is for a loan. And you would split that. And so your equity coming out of that home would be much less. So it is kind of nice and fair if you guys could split those closing costs. And then once he saw it that way, he said, oh yeah, you know what, that does make sense. I'm happy to split that. So just sometimes just, you know, making, the more that's in the decree, the better, or the MOU, just so there's not a lot of gray area where then the people are left to figure it out on their own, you know, well after the decree is completed.
That's all really good information, I know. And I've learned a lot just talking to you. You know, we've worked together now for a few years, and just to know some of those details, especially about the debt. You don't realize that as you're splitting that out, it's going to make a difference someday. You know, it really can make a difference a year from now. If there's still a credit card out there that was joint and now they're trying to qualify, you don't realize the ramifications. And so I've really tightened up even that part of the RMOs and when we write them up. And about in the closing costs, I totally agree. We always say, hey, it's an incident to the divorce. This refinance is part of you exiting the marriage and kind of an expense that's part of this. So you should be splitting it. So it's good to really, be detailed so everyone understands and there's no surprises. That's where it's already kind of a stressful time. It's nice to have expectations set. So those are really good tips. And I appreciate you sharing those with us. Tell us how one of my clients, or how people can get a hold of you, and how you like to work with people, and kind of what that looks like.
Sure. If it's your client, you know, usually a joint email intro is great. If they happen to be watching this video, they could always just call. My cell is 303-961-6906. It's listed online. It's very public. I'm Michelle.Oddo with the Oddo Group at Leader One Financial. They can email me at just Michelle.Oddo, which is M-I-C. You could probably put it underneath, I'm sure. Yeah, but if you just email Michelle.Oddo, you can see it's O-D-D-O. Leader One Financial, my information pops up online, Google, whatever. But an email, a phone call, a text, just any way, Facebook, message, whatever. I'm really available and online in all of those ways. And just to reach out, like, hey, saw you, or here's what's going on. Can you help? I just would love to chat with you. And I'll immediately get on a phone call. Getting their information into this, we'd like to get them into the system and pre-approve them right away. Because even if they're not ready to go, as we mentioned, at least we have a baseline. We know where we're at, we know what it looks like today, and then what do we need to do to get them ready. So when when whatever it is they're doing is complete, whether it's a separation, a divorce, whatever, we at least have our ducks in a row up front.
Excellent. Yeah, I know. And I love working with you because you do answer your phone. You're totally responsive. Anytime people need numbers, I can count on you. And I really appreciate that because you're there to really serve. And I know you've got such a great heart for people, and you have a whole staff that works with you. So it makes it even better to be able to get a hold of you and get things done in a hurry, or efficiently, I should say.
Thank you. That's important to me too, because a lot of these things are time sensitive, and there's a lot of emotion, and it's raw, and both of us, when we're dealing with a divorce situation, it's different than it is for me, just a normal purchase or refinance, because there's a lot of emotion. It's not just the numbers. The numbers are important. All those things matter. But it's really important to me to make sure I'm protecting, the client's best interest, and being very fair in how we're assessing the situation, and not, getting into any kind of, we're just trying to be very, look at the whole picture and be very rational and really help people see through to what is their end goal and what's the best way to get there.
Awesome. Well, thank you so much for your time and sharing all that knowledge with us. And I look forward to seeing you at our next workshop.
Thank you, Leslie. I appreciate you having me on. And again, if anybody has questions, just feel free to reach out. Whether I'm doing a mortgage or not, doesn't matter. I'm always, able and willing to help. And that's kind of my passion. So I appreciate it. Thank you.